Okay, we are now recording. It is Friday, January 22nd, and want to welcome everyone to, I guess, what is the first learning lecture of the year. And it's really apt that we're going to do one today on taxation, because taxation is really that aspect that so many of us really need refreshers in, because we don't deal with it every single day, but we know that it affects our lives. So before I go into that, and before I kind of load up the presentation and everything else, a couple of caveats. Firstly, our website is, or our feed in Facebook is private. So whatever is said there is confidential, no problem. These videos are public. They're posted on a variety of public forums. Please be advised. Also, I just want to thank everyone. We haven't mentioned this, but we are now pushing on 5,500 members, all of whom are, we are checking very carefully, all of whom are industry professionals. So this group is really coming together nicely. I think we have a good dialogue. I think everyone is here for the right reasons. And I just want to thank everyone for being an active contributing member of our group. It means a lot. Thank you very much. I'm going to turn my screen share on for a second, and I'm hopeful that you guys can see what it is I'm showing. And then, hold on one second. Let me just bear with me for 1 second, please. All right, can you guys see my screen properly? Can someone just confirm?
Yep.
Yes.
All right,
Yes.
perfect.
Yes.
Perfect. Okay. So there are a whole lot of real estate and taxation considerations that we could go through. Let me first describe what the purpose of today is and talk about why this may be a two-series sort of discussion, just because I don't want to race through certain elements of this. There are a lot of taxes that we have to approach. My goal in approaching this today is to approach this from the perspective of a real estate practitioner who understands these taxes exist, but doesn't really quite understand the nuances, and more importantly, doesn't understand necessarily how to apply the fact that they know these taxes exist to the daily challenges that they have, where they are trying to say, okay, well, how do I apply that to, say, an ROI analysis or anything else? So we will be going through that kind of as we go. And I'm going to start to just make us comfortable with something that I know we're all familiar with, but I'm going to go over it because there's a lot of new players in the scene as well, and there are certain rules that we should really just clarify. So what I'm going to deal with is land transfer tax. And I don't really particularly want to go over the math. The reason I don't want to go over the math of the land transfer tax, I'm going to talk about how it's done generally, which is a graduated amount. That is to say, if you take a look at the way this is applied, you'll see that on the first $55,000 in Toronto, or if in Ontario, it is 0.5% that is applied. And between 55 and 250, it's 1%, and so on and so forth. And you probably remember this really from your OREA courses. The reason I don't want to go into that in any great detail other than to say it's a graduated amount is because you are crazy if, when your client says, how much land transfer tax do I pay, you whip out a piece of paper and a pen and start doing this calculation. Rather, what you're going to do is you're going to type in land transfer tax calculator into Google. It's going to spit out an amount. And then if something looks wrong to you, you can kind of revert back to this chart or others and understand how it is that that was derived in the first instance. I don't really want to go into this for that reason, and we have a lot more substantive stuff to talk about. But what I do want to mention is land transfer tax goes up in stages. And practically, if you take a look at these numbers, above $400,000 in Toronto, your land transfer tax is 4%, and in Ontario, it is 2%. Below $400,000, it is an apportioned amount. It is not exactly 2%. But if you are dealing with a hugely valuable property, say $3-4 million, and you just need to rough it quickly, if you're doing a bridle path property in Toronto and you're paying $16 million, I just got one of those in my office. Well, very simply, what's my land transfer tax? I don't know the exact figure, but roughly 4%. That's a good answer. It's going to be slightly less than that because, of course, the first $400,000 of value is a graduated amount, but that's the way it kind of nets out. You'll also note that in Toronto, well, anyways, I'm going to just leave it at that because you have your land transfer tax calculators. What I would like to talk about with land transfer tax are the exemptions and the first-time home buyers rebate, because there is quite a bit of confusion as to who qualifies and what qualifies and everything else. And so I wanted to just point out that everyone, firstly, is of the land transfer tax as a matter of course applies to all transactions. That's the way the framework with which you should be approaching things. There are exceptions. And the first exception is where there is no consideration. Now, allow me to just stop for a minute and tell you where there is a confusing aspect of tax. When you are dealing with non-land transfer tax issues, when you're dealing with anything to do with the CRA, so if we're talking, we could be talking about capital gains, we could talk about withholding, we can talk about whatever it is. There is a section of the Tax Act called imputed value. And what imputed value means is it doesn't matter what you sell for. The CRA will determine what the true fair market value of a property is for the purposes of taxation. The Land Transfer Tax Act is not part of the CRA. It is done via separate statute by the Ontario Ministry and the City of Toronto Act regulation. And accordingly, imputed value, which exists for every other portion of tax, does not exist for the purposes of land transfer tax. And what that means in English is that if you transfer land for $0, that is the amount of money you will have to pay in land transfer tax. That is the amount that will be inserted into the deed and thus the amount that is transferred. That's why, by the way, on land transfer tax, when you go through land registry, you'll see $2 or $0 throughout. There is no imputed value, and thus we can manipulate the price to manipulate tax. But can we? Well, we can if we truly are paying $0. But if there is other consideration in the form of anything, a side payment, property for property, shares for shares, all of that must be recorded legally. And the true value of that must be recorded and tax must be paid. What's more, if you put down $0 and you are transferring property in general to a friend, and you put down $0, and it's a true $0 transfer, the law of land transfer tax exemption is such that you have to still pay land transfer tax if there is an existing outstanding mortgage, because the law is that you must pay on the greater of the consideration value or the mortgage then on title. So, for instance, in the event that a friend owns 50% of a property with you and you have made arrangements to transfer it for $100,000, but there's a $400,000 mortgage on the property, well, then the land transfer tax for the transference of that 50% from the friend to you will be on $200,000, that being half of the mortgage amount that exists. And despite the fact that you're transferring it for $100,000, $200,000 will be used for the purposes of calculation of the Ontario land transfer amount. Because again, the rule is that you pay land transfer tax on the greater of the consideration value or the mortgage then on title. There is another group of people who do not pay land transfer tax, and that is a transfer between spouses or former spouses when there is a written separation agreement between them. And if that is the case, which is often the case, then no land transfer tax is payable. Again, your lawyers will advise if the particularities of the separation agreement and whether or not the consideration that is being transferred will in fact accrue, but oftentimes there is no land transfer tax on those aspects. And last, transfers between individuals and family business corporations. Now, this was actually set out in, a lot of people don't know about this, but this was set out in a regulation, and it was recently tested in a case that was lost by Upper Valley Dodge Chrysler Limited, but does definitely exist. And if in fact an individual, not a corporation, but if an individual transfers to an active business. An active business is a non-real estate business. It's something that has 5 or more employees. It's a defined term. Employees, not contractors, employees, like you're paying CPP, EI, and everything else. If in fact it's transferred to an active operating business owned by that same individual, then you can be exempt from tax. Again, we're not going to go into the particularities of this. It doesn't matter. I'm pointing out to you that there are exemptions to paying land transfer tax, and your legal counsels will know what these things are.
Or can I just ask, because I got stuck on number 1. In your example, if it was $100,000 consideration for a 50% interest, and there was a, I don't remember what you said, 200 or 400.
I said 400.
Then I would be paying land transfer tax on half the value of the mortgage, which is 200,000 plus 100,000 consideration.
No, because the law is you are paying on the greater of, not the combined amount. That's not what the legislation says. The legislation says you have to pay on the greater of the 2 factors.
Okay.
We can talk about it afterwards, but look, I'm hesitant to challenge. If you think otherwise, I'm always hesitant to challenge you, Ty, because you seem to know this stuff way better than I do. But
I mean, I use the calculator, but I'm just, my understanding was that you're taking, you already, okay, I think when we say 50%, I'm assuming they're both on title. And
yes, I was assuming they're both on title and one person is transferring their interest to the other.
50% of the mortgage, because he's already on the mortgage for 50%.
That's correct. That's correct.
And the other 50% of the mortgage.
That's right. Yes, exactly.
Okay. All right. Well,
okay.
We'll talk later.
We can talk about it later, but I'm certain that it's the greater of. I know this quite certainly.
All right.
Okay, so let's talk about the big one, the one that everyone is concerned with, the exemption that allows you money off the land transfer tax when you're a first-time home buyer. So the rebate in Ontario is $4,000. That is to say you can get up to $4,000. And the rebate in Toronto is $4,475, meaning that if you buy a property in Toronto, you can qualify for a rebate up to $8,475. That's consequential. What are the rules of actually applying? Well, first, you have to be a Canadian citizen. By the way, that wasn't the case until about 4 or 5 years ago, but that was changed. So there's still some remnants out there where people are like, I don't remember, I'm not a Canadian citizen, but that's not a problem. It's been changed. You must be a PR or you must be a Canadian citizen in order to apply for this. You must be 18 years or over. That's not a big surprise. You must live in the home within 9 months of purchasing it. If your first purchase is a rental and you are not moving in within 9 months, you do not qualify for the first-time home buyer's exemption. And you must swear an affidavit. It is fraud to swear it improperly. That this is, in fact, going to be something where you are living there. It is not your first discount on a house. It is your first discount on your house, on the one where you live. And you cannot have owned an eligible home before. And if you have a spouse, they cannot have owned a home. So let's talk about what that is. So what's an eligible home? Well, an eligible home is actually defined by the Act. And it does not include vacant land, large-scale multi-residential or commercial properties. So if you own one of those giant multi-res buildings with like 100 units in it, you're still a first-time home buyer. Now, I don't know many people who don't own a home and then own a 100-unit multi-res building, but I'm sure it happens. I do know a lot of people who own vacant land. I do know a lot of people who own vacant land, absolutely. And that is not an exclusion. You are still able to go ahead and qualify. If you are buying a duplex, a triplex, and a fourplex, and you are planning on living in it, it is eligible. So is, by the way, shares in a co-op where you're buying shares. So it's not technically ownership of land, but that is considered an eligible home as well. And what about a spouse? Well, here's something that confuses real estate lawyers a great deal because we are not family lawyers, and it confuses real estate practitioners as well. The Family Law Act defines a spouse as a married spouse, someone who is married. In fact, by the way, the entirety of gay rights legislation in this country came about because not being able to be married to one another meant that gay couples were being discriminated against, specifically because they didn't have the matrimonial home rights that the Family Law Act prescribed. And the Supreme Court back in 2000s basically said, no, 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 that is discriminatory against the Charter. We must allow for other people to have these same rights. And as a result, gay people are now allowed to be married. It was really on the basis of matrimonial home. But very confusing for people. So that means married. Married is married. We understand what that is. That's going down to Elvis in Las Vegas and having him on roller skates marry you and do whatever it is. Or maybe you have a more classy wedding in mind. I don't know. But that's what married is. But there's another definition of spouse contained in the Family Law Act, which the government likes to use to its advantage and does here. Under Section 29 of the Family Law Act, a spouse is defined as people who are married to one another or have cohabitated continuously for a period of 3 years or more, or have a child together. It is that definition of spouse, not to be confused with the definition in Section 2 of the Family Law Act that defines it as married spouse. It is that definition of spouse that exists for the purposes of denying the eligibility for the purposes of land transfer tax. So if in fact you have lived together for 3 years, or if you have a child together with someone, then you are considered a spouse for the purposes of land transfer tax first-time homebuyers exemption, and thus are disallowed from claiming it if your spouse has, at the time that you have been their spouse, owned property. That's a bit confusing. And I'm not saying to you that it makes all that much logical sense, but when has tax really made any logical sense? I guess I know that there's some questions being asked. I'm going to go into it afterwards. I just have a lot of ground to cover here today, and I'm very doubtful I'm going to be able to get through this whole thing. I think we're going to have to do a second. So that's what I'm going to say about land transfer tax. It is graduated. Certain people don't need to pay it, but that's really in the form of your lawyer. And from your perspective, the land transfer tax is, and the first-time home buyers exemption is more properly understood, and the definition of spouse and eligible home are now properly understood, such that you can perhaps have a better understanding of what you may want to flag for your lawyer when you bring a file to them and say, this is a first-time home buyer. Because if you know that they have a kid together, that may, and one of them has a property, that may be a flag. If you know that they've owned an investment property, which is a triplex somewhere, that may be a flag. And of course, the lawyers will do their investigation, but you're trying to prep your clients for the costs that they're going to take on. And in Toronto, this very discussion is worth about $10,000, $8,475. So it's an important one to have and to understand. Okay, let's talk about the next form of taxation that all of you deal with, that I think is important to address, because most people really don't understand how this works. And that is the taxation rate. So it is the case that if you own property in Toronto, you have to pay municipal tax. There is an entity called MPAC. And for those of you who are just entering into the field, you may have some experience with them, you may not. And MPAC stands for the Municipal Property Assessment Corporation. And what MPAC's job is it's to take a look at every single PIN in the province of Ontario on a 4-year basis. And every single property in the province of Ontario is allocated an actual value. And every 4 years, if you're a property owner, you'll know MPAC comes and says, hey, here's the value of your property. And at first you open it up, you're like, all right, I purchased this for X, and now MPAC is saying this. And then exactly 1 second later, you think, oh, wait a moment, does this have adverse consequences? And indeed it does. Because the way that we determine the property tax payable per PIN owned or per property owned is through what's called the mill rate. So I have an example of the 2019 mill rate in Toronto. And you will note on this that the mill rate over here, I can't really see it because I have people's faces in the way, is 0.614770. It's actually fallen. I think now in 2021, it's 0.59. And if you're wondering why, for the first time in history, you're hearing about tax rates actually falling, the reason is actually quite simple. Property values are skyrocketing. So the city of Toronto is still making more even with the lower tax rate because the values keep on increasing way, way faster than the city of Toronto lowers its tax rate. And in aggregate, the city of Toronto is much better off. But right in 2019, it was 0.614. And you can discover this by simply going to Google and typing in Toronto mill rate. That's what you would do. Or Vaughan mill rate, or Mississauga mill rate. And these charts will come up. And you'll see 0.614770. Again, now in Toronto, you'll see 0.59 something. All you need to do to determine what the taxes payable are is to take your assessed value from MPAC in the given year and multiply it by the mill rate. That's it. And as a result, I am always shocked by the amount of agents who come to me and say, hey, Mark, here's an agreement. We think the taxes are wrong. They're saying it's right. What's the deal? I say, well, we all have access to public records, right? The public records on your MLS system. And that will show you what the assessed value is from MPAC. I know where this property is located. It's located in Toronto. So let me just do out my multiplication. That's very simple. Oh, look, it's correct. Oh, look, it's wrong. Understanding the fact that this is how municipal taxes are derived is just important as you're doing your practice and being able to say to people, hey, here is how this all works. So in this instance, MPAC valued something at $592,194. I simply take that $592,194 and I multiply it by, I'm dealing with a residential property, the total tax rate, right? Because it's the city tax rate plus the education plus the city building fund. And that comes to $3,640.63. And that's the tax rate of that price in Toronto in 2019. It's just that simple. I'm going to pause for a minute before I move on to the next tax. I know that there's been some questions that have been written. Does anyone have any questions they want to pipe here? Let me just take a look at what the chats are. And let me see if I can just answer one or two questions before I go on. So Daniel has asked, what about in the event someone purchases and has a pre-con unit or house, gets married in the meantime before closing, spouse owns a home? Would they still? So Daniel, to answer your question, so what Daniel is asking is the qualification of being a spouse, is it determined at the time of closing or the time an agreement of purchase and sale is entered into? And the answer is that the determination of whether or not you are a first-time home buyer takes place at the time of closing. This means practically that if you had signed, say, 2 agreements of purchase and sale, the very first one you closed on would be the one that you would be able to qualify for, not the first one you signed up for with the builder. Jack asked, what if a buyer is on title of a property in another province? Jack, the rule is, and I should have mentioned this, that if in fact you have owned property anywhere in the world at any time, you do not qualify as a first-time home buyer. So if you've owned not property, if you've owned eligible property, remember, if you've owned vacant land or something, that's fine. But if you've owned the eligible property that I was talking about, anytime, anywhere in the world, you do not qualify for the land transfer tax exemption.
Even if it's a 1% ownership that you went on title with your parents so they could get their mortgage.
Okay, that's an excellent question. So if in fact you went on title with your parents and have 1% ownership of a property, the benefit, if you are a beneficial interest declared through a bare trust, which should be done by your lawyer at the time that you go on for 1%, then no, you can still qualify. Allow me to explain in some English for people who are not clear on what I'm talking about. It is often the case that people find themselves going on title. They don't have another property. They have a good income and they help someone else qualify. And so they go on for 1%, which from the bank's perspective is sufficient. Have they then ruined their eligibility for their first-time home buyers discount? Well, a lawyer that hears that someone is doing that should immediately say, aha, so you're saying you're going on for mortgage qualification purposes only. Let's have you enter into a bare trust agreement wherein the legal ownership certainly vests in you, but the beneficial interest does not. And then if you look at the Land Transfer Tax Act, you will see that there are huge sections of the act dealing with beneficial interests. And what they say in English is that if all you have had is a legal interest, but not a beneficial one, then you can still qualify for the exemption. But again, you'd want to make sure that your bare trust agreement was in place at the time that you entered into the helping hand registration of your name on your friend's property. Make sense?
Well, then you breach the rules of your mortgage because the mortgage wants to be sure that there is no trust. So people should know that that's not an easy out. You have to deal with the mortgage end of it as well.
That's interesting. I never really thought about that. I'll give some consideration to that and get back. I'm not going to talk about it just because that's never something I've really considered, nor do I know that that's necessarily a restriction. But let me look into that. That's quite interesting. Thank you for that. Cordian asks, what determines how much of the $4,000 the buyer will get? Well, Cordian, it's very simple. You qualify for the maximum exemption you're entitled to. So if land transfer tax is $3,200 payable in total, you qualify for that whole amount off. If it's $4,100, you qualify for $4,000, and then you have to pay $100. Gurang asks, do first-time home buyers get the LTT rebate if they own residential property outside of the country? They do not. Anywhere in the world is the exemption. You must not have owned property anywhere in the world. BA asks, I'm sorry guys, I'm going to move on after this question to the next tax because I really want to get into the meat. I'm cohabitating for 3 years, but my partner owned a home 5 years ago. I never purchased a home. Do we qualify for the land title rebate? Yes, you do, because the partner owned a home 5 years ago and has sold it. They did not own it while you were spouses. And accordingly, you, never having owned a home and never having been a spouse with someone who had a home at the time that they were your spouse, do qualify for land transfer tax. Just one last thing. Deidre writes, Toronto is cheap taxes. And while it's true that Toronto has lesser tax rates, mill rates, than anyone else in the GTA and surrounding area, we also have much higher property values. There's two multipliers. There's the property value and the mill rate. And it's great that the mill rate is lower, but the property value is higher. And as a result, on average, Toronto property taxes are much higher in aggregate, though you're correct that the rate itself is lower. Okay, if you don't mind, I'm going to turn my attention now to moving on and turning to income tax. Now, income tax is really essential to understand. And the real thing that's going on in your heads, I know because, it used to go on in mine, is I understand all this. I understand that there's income tax. I understand that there's capital gains. But I, for the life of me, do not understand how to apply that to my daily work. I don't understand if someone is sitting there saying, I'm going to sell my property. I don't understand how to tell them this is the taxes that will be paid. Well, first off, you should never say this is the taxes that should be paid. That should be done by an accountant. But what you can do as you become a more seasoned agent is you can actually explain that, yes, there are taxes to be paid, and here is how taxes are paid generally. So let's work on some assumptions. I'm not promising this applies to you, but the assumption is that you're in this tax bracket and thus you have to pay these amounts. So let's talk for a second as to how this income tax and capital gains works. And some of you may have heard me talk about this story before. Some of you may have read it because I think I've done it as a write-up out in March. But I like to pick on a particular apple farm just west of Toronto and explaining the difference between income tax and capital gains. There is an apple farm west of Toronto. I haven't said this for about a year and I do enjoy it, so you'll permit me to just pick on them. And the apple farm sells apples for an extraordinary amount of money, whereas you can walk into Loblaws and pay $5 or $6 for a bag of apples. Mr. Fudley, we'll just call him Mr. Fudley because we like to protect the anonymity of various people we talk about. Mr. Fudley and his apple farm charged $20 a bag. Fortunately for us, Mr. Fudley has made a very nice round number that we can actually explore how income and capital gains work. So let's put ourselves in Mr. Fudley's position for a second. Mr. Fudley has spent his entire summer or spring planting his seeds, preparing to poison the children of Ontario. By the way, that's what it is. It's laden with pesticides. Go to an organic farm next time. Not that I'm talking about anyone in particular, but go to an organic farm. Still, if you're going to take your kids there because they have an awesome hayride and they have some great slides, Mr. Fudley goes ahead every single year, prepares apples and sells them for $20 a bag. Mr. Fudley does very well for himself. And as a result, when Mr. Fudley takes in $20, let's just assume that there was no corporation or anything else. Let's just assume that that just went straight to Mr. Fudley. Mr. Fudley would have to pay tax on that. Now, what would he have to pay? Would he have to pay income or capital gains on that? Well, let me ask you, what type of revenue source is that? What is Mr. Fudley doing? Well, Mr. Fudley is producing an income. That's what he does for a living. He poisons Ontario's children with, apples that have laden with pesticides. This is a public talk. I should probably keep this down a bit. All right, he gives very healthy apples to everyone, and everyone is bestowed with his benevolence. There we go. We're going to start with that. So he goes ahead and he produces a $20 barrel of apples, which your kids go ahead and pick. He then goes ahead and he sells those for $20. That $20 is his income. That's what he does. And as a result, because Mr. Fudley does very well, as you will see in these marginal tax rates, Mr. Fudley, who makes more than $220,000 a year, has to pay 53.53% of every single dollar that comes in after expenses to the government. Now, he didn't need to do that on the first bag of apples that he sold. The first bag of apples that he sold, he only had to pay 20.05% income until he got to $45,000. At which point, once he sold $45,000 worth of apples, he had to pay 24.15% to the government. And then when he sold 49.020, he had to give 29.65% to the government, and so on and so forth. And he has to do this for every apple that he sells. And because Mr. Fudley sells so many apples, he quickly, within one day, gets to $220,000. And thus, realistically, for every dollar that he takes in after expenses, he is passing 54% of it over to the government. Some of you may look at this and balk and say, oh my God, I can't believe we pay so much taxes. And I'm just going to do a quick political aside and let you know that governments actually, depending on which government is in power, fiddle with this tremendously. So when the Conservatives were in power, as an example, the tax rate, the top tax rate of 220 was actually at 44%, 43%. This was but 10, 15 years ago, 10 years ago, I think. The top tax bracket was about 43%. Now it's 54%. And if you just look at that stat, you would say, oh my God, what crooks, here we go. But you know what happened? We've raised our taxes to 54%. But you see all of these other income brackets, the 20.5 to 24.15, these have gone up massively, meaning that what the government has intentionally been doing, I'm not saying you should agree with this or not. This isn't a political diatribe. I'm just trying to explain to you what governments do. I'm not trying to take a position on this. What the government has done is they have massively increased the cushions that are available here, such that everyone who is making less money keeps more of it. And those people who make the most are paying more. Of course, then comes the argument, well, those people will leave and everything else. And again, those are the political arguments. But that is what the Liberal government has been doing for the past 10 years. And there are other approaches that say, listen, if you tax capital, it's going to leave and it's not going to be here. So this is all well and good, and we would all agree with this, but the capital is going to leave. And that's the political dialogue that takes place inside the Ministry of Finance every time there's a change of government, just so that we're all aware. Let's go back to Mr. Fudley. So Mr. Fudley goes ahead and one day says, you know what, I'm tired of what I'm doing. I'm tired of poisoning Ontario's children. I'm tired of whatever it is. I'm going to get rid of this. I'm going to cut my trees down and sell them. And Mr. Fudley does that, and he sells his trees for firewood. And he gets $20 per tree. Now, what is that? Well, that is a capital gain. Why? Because he's selling the very asset that he used to make his income, the tree. This is different, by the way, than a Christmas farm that's right up the street. And the Christmas farm right up the street sells Christmas trees. What's their income? They're both selling trees. But in one instance, Mr. Fudley is only paying half the amount. You'll see that the capital gain is half the amount of the income rate. So on if he sells if he sells $20 worth of trees and his income bracket is $220,000, Mr. Fudley is only paying 26.76% on those trees. Whereas the Christmas tree owner, because his trees are like Mr. Fudley's apples, are paying 53.53%. And thus you can see that whether something is income or capital gains is in the eye of the beholder. Why does this matter? Well, why does this matter for real estate? Well, it matters because Mr. Fudley's apples are like rent. And the condo that you own is like the tree. And it's always the case that owners of property are trying to say that they are owning the condo, the tree, in order to produce the rent, the apples. And it's always the case that the CRA is saying you are owning the condo, the Christmas tree, to sell the Christmas tree, and the rent itself is a byproduct. This is the perennial fight that takes place between a taxpayer for income and capital gains. Income, capital gains. We are always trying to say something is capital gains, and the CRA is always trying to say it's income. Why? Because the CRA makes double the money if they can say it's income, and we want to spend half the money with regards to the capital gain. Does that make sense? I'm going to pause for a second and just see if we have any questions, because it seems we do. So just one second, I'm going to go to the chat. All right. I think I know Mr. Fudley. Lisa, please do not tell Mr. Fudley that I have befuddled his business. Is Mr. Fudley married? Asked Ty. Yes. Well, if he isn't, I'm first in line. And all right, so there's no questions here. We're all good. All right, let's move on. So let's talk about capital gains now, and let's talk about income tax. So after your expenses and deductions, any profit realized on the sale, which is not a primary residence, is subject to capital gains. And 50% of those capital gains are subject to your rate. So one way of saying things is that this is my capital gains rate. Another way of doing it, which is equally valid, is to take the actual gain, divide it in half, and then multiply it by the income tax rate, which is actually what is done. So let's talk about an easy example. So the original purchase price of a property is $400,000. The sale price of a property is $500,000. And so we're going to assume, for the purposes of this, that there's a profit of 100,000. Now that never actually happens, right? Like, you're going to load up every expense you can imagine. You're going to talk about the realtor expense. You're going to talk about the fact that you had to repair a boiler and a roof. And we could talk about that ad nauseum. I'm just talking about conceptually how this works. What that means is that 50% of that profit, that being $50,000, then goes into Mr. Fudley's income. And because Mr. Fudley does very well for himself, he is at the tax bracket, the highest tax bracket in Canada, of 54%. Many realtors are there too. And what that means is that at 54%, Mr. Fudley would have to pay 50,000 times 0.54 to the government. $27,000 is the capital gains tax. So if, in fact, the CRA came and said, by the way, this is income, not capital gains, then that $100,000 would then go into the 54% tax bracket, and thus it would be 100,000 times 54, and $54,000 would be payable to the government. Let me pause for a minute. Let me just see if there's any questions. My son loves Mr. Fudley. He's listening to this webinar and is very disappointed. Okay, guys, enough with Mr. Fudley. We're putting that one aside. Okay. I keep on seeing the chats pop up. I keep on thinking we have a we have a question. All right, let's move on. So we understand now how this works, and practically what this means for your client is, if they've held on to a property for 3 or 4 years and they're saying, well, taxes are really expensive if I sell, and you're trying to convince them to sell. Well, one of the things that makes for a good salesperson, one of the things that can convince someone to sell, is actually quantifying the fear of tax. So if you say, look, you bought this for $400,000, you're selling it for $600,000, so you have a gain of about $200,000. Of that, you've already put in $50,000 into the house. So what we're looking at is a gain of $150,000. It's going to be a capital gain. You've held onto it for 5 years. We're assuming you'll speak to your accountant. So $75,000 is going to be included in your income. That 75,000 is going to be put up against, let's assume you're in the highest tax bracket. I don't know your finances. We're going to multiply that by 54%. So we're looking at $40,000. Yes, you're going to take a $40,000 hit there. Okay, all right. Is that worth it to you? And at least you've quantified what the capital gains hit is. Of course, what you need to be aware of, what's very important for you to be aware of, is that there are other taxes, particularly on homes where you have had rental. And I'm going to talk to you about that now. Oh, Ashley has just asked, if the 100,000 was Mr. Fudley's only income that year, his tax would be 43.43%, correct? No, because if it was $100,000, Ashley, so Ashley just asked, if Mr. Fudley made only $100,000, his tax would be 43.41%. And that's not correct. If he made $100,000, he would first have to pay 20% on the first 45,000, and then 24% on this amount, and 29% on this amount, and 31% on this amount, and 33% on this amount, and 37% on this amount, and 43% on only about $2,000 worth of tax. So it's a kind of an addition. It's kind of like land transfer tax, if that makes some sense. So please be advised of that. And of course, speak to your accountant about it if you have any questions, or me later on. And Bruina says, when the money of a sold asset is paid to the seller by partial portion in 2 years, the deposit is in 2020 and the balance is in 2021. What is the tax year of the transaction for capital gain? The tax year is the time that the closing takes place. It's not when the agreement of purchase and sale or the deposit comes in. Just FYI. Okay, let's move on. If you are to really show your client that you understand things, you also have to deal with the other tax, the tax that no one thinks about, but the tax that is incredibly real and that affects us all. And that is CCA depreciation. So you know how Mr. Fudley went ahead. So there is in the taxation schedule, in the taxation book, there's a whole chapter really on depreciation schedules. It's not really a chapter. It's not a part of the agreement, but there's a whole section of the Tax Act that deals with depreciation schedules. So if you have a computer, it depreciates at, I think it's over the course of 5 years. And if you buy a car, it depreciates over the course of, I don't know, 7 years, I think. By which I mean every single year, because the CRA doesn't want to run around and look at every car or every computer in the world and say, okay, this is now worth this. That would be insane. So what they do is they say, we are just going to assume that something is losing its value over the course of time. And that loss in value is a deductible expense. So you know how let's say this one here, let's say Mr. Chudley was selling a bag of apples for $20. Well, Mr. Chudley is not a good example. Well, actually, Mr. Chudley is fine. Let's say Mr. Chudley was selling one bag of apples. Let's say he was let's say he had earned $220,000 and he sold one extra bag of apples. He would be allowed, and he bought one computer for his operation. And the computer cost was $1,000 when he bought it. And a computer depreciates over the course of 5 years. What that means is every year over the course of those 5 years, $200 of that computer can be expensed as against the taxes that are payable by Mr. Chudley. That's an example of an expense. And the reason that depreciation works is because invariably, after you throw in everything against the kitchen wall, after you speak to your accountant over and over and over again, and you say, look, can you add in this expense? Can you add in this expense? The accountant does a little calculation and says, okay, you now owe $60,000. You're like, is there anything else? And your accountant says, well, you have a building and the building depreciates at 4% per year. So let's take this example that I have here. Let's say that you purchase a property at $1 million. So there's a portion of the property, a portion of that $1 million pertains to the property, and a portion of that property pertains to the building. And there are professionals, particularly your accountant will be able to help you with it, that can allocate the value. So in this instance, I'm assuming that if you've made $1 million purchase, the value of the building itself is about $800,000, and the value of the land is about $200,000. Now, land does not depreciate for obvious reasons, right? It's been there for 5 billion years. It's going to be there for 5 billion more. It's just land. Buildings do depreciate. And according to the CCA depreciation schedule, buildings depreciate at 4% per year. So we have a building value in year one that is $800,000. And what that means is that it will depreciate. There's something called the half-year rule. I'm not dealing with it. We're not dealing with accounting. I'm just trying to conceptually show you what taxes are. So please ignore the fact these numbers aren't exactly accurate because of the half-year rule. I'm ignoring it for now. In year one, if there was no half-year rule, if we were allowed to depreciate that at 4% per year, what that means is it's $800,000 for building value. My depreciation amount is $32,000. So if I owe $60,000 to the government, I can reduce that $60,000 by $32,000 and pay tax to the government that is effectively, what is that, $28,000 as opposed to $60,000. That's a huge thing. And of course, you're going to do it every time because you don't want to pay $60,000 to the government in year one. You're going to take your depreciation for sure. Hold on a second. I see that we have a couple of questions. Let me just go to them and see where we are. Can land not depreciate if contaminated? Yes, it can, but that's not done through a depreciation schedule. That is done through write-offs and other mechanisms. It's not done through the CCA depreciation schedules, Lisa, but good question. All right, so let's keep moving on. Christine is asking, what happens when you sell? So, okay, well, Christine, I'm getting to this. Come on, man. Like, you're taking away my fire. Maybe I shouldn't have read it, but then I was leading up to that. Oh, all right. So you're going to do this every single time. You're going to go ahead and you're going to depreciate your $32,000 in year one. Of course, in year two, you don't get $32,000 because the value of the property is no longer $800,000. The value of the property now is $800,000 minus the 32. So the remaining value is $768. And so in year two, you're going to take 4% of $768 and so on and so forth, right? And every year you can claim a little bit less depreciation because you're claiming 4% as against a lower and lower value. But here's the thing about real estate that every single one of you know in your hearts. That building that you've depreciated for tax purposes, it hasn't depreciated. It's gone up in value. Even if it's a piece of crap and it looks worse than it ever did, it's going to sell for more. And thus, we have additional tax. And this tax is the hidden tax that most people don't think about because technically it might not be payable, but it almost always is. And that is the tax called recapture. Because remember how we took $32,000 in year one and $30,000 in year two and $29,000 in year three? Well, when you sell for $2 million, it's clear that the depreciation which you were allowed to take was taken in error because the building hadn't depreciated at all. It had gone up in value. And thus, you owe back those monies to the government. And so, capital gains for sure is a factor. But for someone who's owned one of these massive investment property, multi-res investment properties for 20 years, they also have a huge kicker in the form of recapture. And the reason that these multi-res never sell is because A, you're going to have to pay capital gains and recapture. You want to put that off as long as possible. And B, what the hell else are you going to do with money that's going to make the same returns? So depreciation, which is predicated upon values going down in time, always kicks up a recapture for us in our GTA markets where properties are selling for more. And as a result, in the instance that we have here, we would have a further $147,701 would have to be included as part of our income in addition to capital gains. So in addition to the fight that you're going to have with the CRA to say this is not income, this is capital gains, which you'll probably win if you've held on to it for a couple of years, for 5 years like this, and it probably won't even be a fight. You also have to factor in recapture because what you're trying to tell your client is, listen, yes, you're going to take a tax hit. Here's what I estimate the tax hit to be. And now, you probably can't estimate recapture all that accurately, but you certainly need to mention it to your clients. You need to say, listen, yeah, you may face some capital gains and some recapture, but the market is so much on fire and it may turn down, and now's your time to actually crystallize your gain. Here you go. And you've then informed them of this, and you can say, look, you can figure out what your recapture is with your accountant. And if they say, what's recapture? You can say, well, you know how you've been deducting every single year? If we sell for more, then you have to pay that back. You can at least describe it to them. And you have to understand that that needs to functionally be part of your analysis, because that is what your client is going to be facing at tax time. And the reason that they're going to be, the motivation behind their sale outside of a fire sale where they're in some real trouble, is ultimately figuring out how much they're going to pocket. And recapture and CCA depreciation is a fundamental part of that. Is there a time limit that recapture can be applied? No, there is not. Okay, let's move on. We're now going to turn our attention to I'm going to stop for a minute, and I'm just going to ask, does anybody presently have any questions as to where we are or anything else? You're welcome to unmute and ask the question as long as you mute yourself afterwards, or you can write it. Does anyone have any questions right now? I've been trying to go through them as I go, but does anyone want to stop me before I move on to probate? Okay, we're good. I'm only going to get through probate today. I have a lot more to say about different taxes. We're going to have to do another session next week, guys. I like to be punctual, and I'm going to end at 11 o'clock. So I'm going to stop at probate, and then we have, and then we're on non-residency anyways. So we're fine. So it will be a nice break, and then I'll do the non-resident taxes for next week, and we can talk about the NRST and withholding tax and everything else. So let's talk about probate. When you die, we pass assets to non-spousal beneficiaries. There is a probate fee. And that probate fee is paid to the Ontario government. It's not a tax, it is a fee. And that matters, and I'll explain why. And what it is 0.5% of an estate with assets up to $50,000, 1.5 on assets over $50,000. So if someone dies owning a home and they're giving it over to their kids and the property value is taxed, the property is valued at $1 million, well, then you're going to have to pay about $14,500 in probate fees to allow the court to stamp the will. You either die with a will or without, but one way or the other, you need a court that says these executors are allowed to act. No one is allowed to just take a will and walk into the bank and say, give me the money. This person's dead. Here's a death certificate. Nor are they allowed to go to a lawyer and say, here's my will, here's the death certificate. Please go ahead and register the property in my name. Because as you can imagine, there may be multiple wills and there may be disputes. And as a result, there's a process called probate. And probate is the process where you go to the court and say, hey, court, please confirm that I am appropriately the executor. Please give this your imprimatur. Please give this your stamp. And the court, after going through a process, will do so, but will charge a fee. And it's the probate fee that we're talking about. It is often the case that lawyers are asked whether or not they should add their son or their daughter to title as joint tenants in order to avoid the probate fee. Because if we have elderly dad, and dad is the last of mom and dad, and the property is about to be subject to a $15,000 hit, we know, being real estate agents, that if you own something as joint tenants, property will immediately pass over to the other party upon the death of the first. And so people looking at their elderly parents often say, I should really be added to title to avoid the probate fee that I've just described. Invariably, unless dad or mom are literally on their last legs, terminal cancer, we know that they're going and everything else. If all they are is elderly, it's usually not a good decision. Why? Because, as you are aware, there is a principal residence exemption for homes. We didn't talk about it here, but we are all aware that if you live in a house, it is a principal residence and it is exempt from tax. If you add your son or your daughter to the home and they are not living there, their portion is not exempt from tax. And that is fine if mom or dad dies immediately after transferring the land, because at that point, the imputed value of the transfer will be very close to whatever it is the sale price is. So no harm, no foul. It's simple. There's been no gain, and therefore there's no tax. But if you transfer it over to your kids and then ma or pa live another 10 or 15 years, what you've done is you've taken 50% of a property that would be tax-free in 10 or 15 years and accrued tax on it. And the capital gains tax, as discussed, is significantly more than the 0.5 or the 1.5% of the probate fee. And so this is kind of what lawyers always wrestle with when it comes to people who are trying to plan to avoid probate, which you are allowed to do because it is a fee, not a tax. I'm going to just mention as a final point, because I realized in talking about probate that I hadn't really talked about the capital gains exemption. If you own a property and it is your primary residence, it is exempt from taxation. A couple is only allowed one primary residence at a time. So if you own a house and a cottage, you must elect which of those, because you regularly reside in both, you must elect which of those is subject to the capital gains exemption. It can be decided retroactively, but you're only allowed one per year per couple. And I can talk a bit more about that perhaps next time. We're actually at 11 o'clock. So I just want to open it up and just ask if anyone has any questions about what I've talked about now, whether this was helpful. And then, of course, deal with the non-residents issues in a later lecture, just because, again, there's a lot of ground that we've covered here today.
Mark, I have a question here.
Yep.
A client is basically owns a cottage only as the only property on his name, but is living with his wife at a property which is named under the wife. If he decides to sell that cottage later, would he be considered as capital gain, or could he claim that that was also his private, like a personal residence?
No, he has to ordinarily reside there during the course of the year. So if it's a cottage and if he's not renting it throughout the year, but is instead, going ahead and accessing it in the summer and going up on weekends, he can go ahead and he can claim that as his principal residence, no problem, and get the exemption. But if he's rented it to someone for the course of the year and does not actually store his underwear there, no, he cannot claim that. Now,
well,
if
he was renting it, but he was collecting that rent under his incorporation.
So what?
As a
He rented
separate
it.
thing.
He's not living there though. He's not living there. He doesn't qualify, but he can qualify if he spent some years there. If he spent 5 years there and then started renting it for another 2 before selling the cottage, well, then he would be able to claim that it was his principal residence for the 5 years where he was using it. But no, if he's rented it for the year and he has no ability to actually use it for himself, it's not his principal residence. It doesn't fall under the definition of the term. It doesn't matter if it's corporation or anything else. He's not using the property.
All right. Thank you.
Anything else, guys? Brian is asking, what about using a bare trustee document for elderly parents if joint tenancy were used? Brian, I'm not going to answer that. And I'm not going to answer that. If I just stopped at that and just said, I'll get back to you, I'd look very wise. But the truth is, I'm not going to answer that because I don't really know the answer. It's a good question. And I'm not really quite certain. So I don't want to speak in a public forum about that without doing some research. It's a great question. What about using a bare trustee document for the elderly parents if joint tenancy were used? I don't have the answer. I've never even been presented with that. Very interesting question. Ed asked, I don't think it was mentioned explicitly, but the value you depreciate in a rental is just the building value, not the land value. Yes, I did mention that, Ed. In fact, you'll take a look. I actually broke out what the land value and the building rental was. Here it is, the value at purchase. Building value is $800,000. And we talked specifically about the fact that land does not depreciate. It's been here for 5 billion years and will be here for 5 billion more. All right, guys, anything else? Would capital gains be different when filing as personal or an incorporation? Ish, I'm not going to answer that. And I do know the answer to that, but I'm not going to answer that because I'm dealing with concepts here and I don't want to confuse people with corporations. We've done talks on corporations before. Corporate tax is a completely different thing. Incorporation and personal corporations, I don't want to touch this with a 10-foot pole. I'm talking about the concepts that exist in real estate today only. I can talk to you about that later on. Anything else, guys? Okay, well, look, it's 11 o'clock. Thank you all sincerely. I'm sorry we didn't get through the whole thing, but there's a lot of meat here. We will do a further discussion on this, and we'll also deal with assignments and taxation of assignments, which I believe was the next request of the group. And I'll make sure that we get to that as well. Thank you sincerely, guys. Take care and have a great day. The video will be shared shortly.